Most people think tax planning ends with retirement accounts and real estate. But there's a lesser known strategy that can deliver massive tax savings, and that is investing in oil and gas. It's not just for oil tycoons or trust fund bros. My husband and I saved $25,000 on our taxes in a single year using this strategy as busy, high income professionals. And if you want to watch that video, you can look at it right here. But here's the thing, while the benefits are real, so are the risks. So in this video, I'm breaking down how oil and gas investments actually work, the powerful tax advantages, and how to do it a smart way so that you don't get burned. Most people think investing is just stocks, index funds, and maybe some real estate. But the IRS actually rewards certain investors, especially those in sectors that fuel the economy, like oil and gas. Here's where folks go wrong. They either ignore alternative investments entirely, or they jump in blindly for tax breaks without really understanding the risk. And that's when things go sideways. We don't want to do that. So in oil and gas, a limited partner or an LP is someone who invests capital into a drilling project but doesn't manage the operations. So you're not the one who's drilling or dealing with pipelines. You're a passive investor. And that is what I love most about investing in oil and gas. So you want to think of it like real estate syndications. You put your money in, you get a share of the profits, and your risk is limited to what you invest. But that means you can lose your entire investment. So if you're going to play in this space, you need to play smart. Now let's talk about how the payouts really work. Let's talk about the money, because this surprises a lot of people. Oil and gas payouts aren't usually monthly and steady. They actually follow a bell curve. Early on, you might get little to nothing. Then as drilling and extraction ramp up, you'll see bigger payouts. And over time, the well depletes and the payouts start to slow down again. So if you're looking for a quick paycheck on day one, this is not it. Yes, the tax breaks are real. Through intangible drilling costs and depreciation, you can write off a huge chunk of your investments in year one. That's how we save $25,000. And this is important. The tax benefit can't be your only reason for doing this. This is not a tax shelter. It is a business investment with real risk. And one more thing, brokers can earn high commissions for placing investors in these deals. So if someone is really pushing hard, ask yourself if they're prioritizing your goals or their paycheck. And this kind of deal isn't open to everyone. You need to be an accredited investor, which means $200K in income for the past 2 years, or $300K combined with your spouse, or $1 million net worth, not including your home. You might ask yourself, why? Because these are complex investments, and regulators want to make sure that you have the financial capacity and the knowledge to appraise the risk. But here's what most people miss. This is not a beginner move. You need to be asking questions like, can I afford to lose this money? Does this align with my bigger financial goals? And is this a smart strategy or just me chasing a tax break? And let's be real, there is no eco-friendly way to extract oil. So if sustainability is one of your values, that's definitely worth considering too. Now, let's take a moment and discuss how to find the right partner. Don't just invest with a company that promises the biggest return. You want to vet them like a business partner. So ask, how long have they been operating? Are they drilling in proven areas? And that is essential, because if you want any type of return on your investment, the well needs to have oil. You also want to ask, do they have a strong history of returns? We found our investment through a trusted advisor and still did a full deep dive before saying yes. So when you're evaluating the deal, you want to ask yourself, is this diversified across multiple wells, or are they just focused on one? What are the fees and also the timeline? Because Fees eat away at the payouts that will be distributed to you. What happens if oil prices drop, which is huge, and we don't know the future? And are the profits reinvested or are they distributed? If you can't get straight answers, then you want to walk away from the deal. So here's what can go wrong. Oil prices drop, the well is dry, the company totally mismanages the project, and you lose your investment. So you can manage this risk by diversifying across multiple projects, asking the hard questions, and being clear on your tolerance for risk. Our investment spans multiple wells and proven areas with quarterly reporting and full transparency. So once you invest, don't just forget about it, right? You want to monitor the reports. You want to track your tax deductions and schedule check-ins with your investment partner. This is passive, but not invisible. So if you are a high-earning professional, feeling taxed to death and looking for smarter ways to grow your wealth, oil and gas could be part of that puzzle. But again, it is not for everyone. So if it aligns with your goals, then it could be a powerful tool to build wealth and reduce your tax bill. Want to know how we evaluate investments like this or other advanced strategies we use? Then you want to put a question in the comments because I am full transparency and I love to respond to each and every question. So don't forget to like, subscribe, and share this with someone who's ready to level up their financial life. Until next time, people, stay wealthy. Bye.